Hello, Chris. How are you? Hey,
Excellent.
it's very
How's
good to
you?
see you. How is it going? Can you hear us okay? Can you see us?
I can see you. I assume that you're there with some other people, but it's difficult to see any other people.
Yeah, it is difficult because it's an online event, which always poses a bit of a challenge when you try to see your audience. But Chris, I will pass on the floor to you. You got a 30-minute presentation that we're very keen to listen to, and then we go ahead with a quick Q&A.
Cool.
And whenever you're ready, Chris.
Okay, can someone bring my slides up? There we go. So, hi, I'm Chris Skinner, and I write a daily blog at thefinancer.com, which I've been doing for a long time, over a decade, as well as producing a number of books, of which the most recent is Doing Digital. And Doing Digital is all about banks that I think are doing digital well, which in the current crisis is incredibly important because we've had this lockdown thanks to coronavirus, where everyone's been stuck at home for the last 3 or 4 months. And suddenly everyone's had to work out how to do digital structures because we don't have an office anymore. We have to work from our rooms, our bedrooms, our homes, and that's been a big change to the world. Initially, a lot of people were more worried about the economy than lives. That changed as we realized the seriousness of the pandemic. And then we realized that it's challenging to all of us to wear masks and to social distance and to do things differently. But we are doing that, and suddenly there's been massive behavioural changes. For a while I tried to grow a beard, which was unsuccessful. But equally, we all moved to online conferencing and social calls via video. So there have been some major behavioural changes as a result of this crisis. In particular, a lot of us have stopped using cash. We're far more focused on using card transactions and avoiding contact with each other. So it's very different to the last recession. And the last recession was quite something. It's 12 years ago. I didn't think we'd have another great recession so quickly after the last one. But we are going through another great recession because basically all economies in nearly every country have closed down. Now, what was interesting about the last recession is that was a financial crisis created by the financial system, whereas this is a financial crisis created by the health system. It's very different. But the last financial crisis resulted in the creation of something very new called Fintech. And Fintech rose from the ashes of the financial disaster of 2008 and created thousands of new ideas and new companies to innovate around the integration of technology and finance. In fact, there was almost like a perfect storm 12 years ago where technology matured to the stage where cloud computing and smartphone appeared, combined with a loss of trust in the traditional financial system. And those two factors came together in 2008 to launch the surge of fintech around the world that's now become a multi-billion-dollar industry, and it's still growing. Even in 2020, with all of the challenges we have of the pandemic, fintech is still growing, and a lot of the fintech companies have secured funding before and even during this crisis. So it's not going to end. In fact, if anything, it'll be interesting to see what innovation comes around after this crisis, in the same way as we saw huge innovation after the last crisis. But what's been notable about most of these fintech companies is that they're not like traditional financial firms. They're created by young people like Tom Blumfield, who's just stepped down already as the founder and chief executive of Monzo. Tom's just become the president of Monzo as they expand into the USA. And this is a company that's one of the highest valued fintech startups in Europe, with something like 4.5 billion customers today, and valued slightly less than it was, but still valued very highly in the current crisis. And one of the key things about Monzo, along with all of the other challenger banks like N26 and Chime, is that they become lifestyle institutions for financial needs, because they work on an app and provide everyday banking in an everyday way. And what's been happening with challenger banks is that the traditional banks are becoming boring old banks doing boring old things like boring old bills. So they may get your salary and they may manage your mortgage, but they don't do your everyday banking. A lot of people have moved to everyday banking with new banks. Equally, there's a lot of other institutions like TransferWise that have been growing over the last decade, primarily because they do things in a very easy, everyday way. I use TransferWise specifically because I travel around Europe and I live in Poland, but I have a house in England, and I have to move money regularly between UK and Poland and other markets. And this is one of the easiest ways to do that at a competitive rate that's instant and real time. And real time is a key part of this. So, for example, I had to recently pay for some repairs on my car. And whilst I was in the car showroom, I put the funds onto the account of TransferWise to cover the bill. And it took seconds, and I paid the bill within minutes, which I couldn't ever do historically with traditional financial services. Similarly, a lot of these companies have been created by young people like Vitalik Buterin, who was the creator of Ethereum. And Ethereum is the distributed ledger platform of smart contracts that almost everybody is committing to using for the future of infrastructure of industry. But when Ethereum was created in 2015, Vitalik was just 19 years old. And so a lot of companies have been created by young people because they understand and get technology much better than those who are maybe more mature. There's even companies that have been created by 9-year-olds, like this coin that's in Asia, created by a 9-year-old Thai girl that's actually based on distributed ledger technology. So even 9-year-olds are creating companies that change the way we think about money and finance. But generally, I think what we're seeing is a revolution, like Revolut, of money and the way we think about money and finance with technology. And it's not just being created by young people who get technology, but by young people who maybe understand money and finance. Nick Storonsky, the founder of Revolut, was working for Lehman Brothers in September 2008 when they went bankrupt, and went on to create the highest valued fintech company in Europe. And equally, we're seeing others like Stripe that are taking over global platforms as payments and API checkout services. So Stripe was a company created by Patrick and John Collison when the brothers were 21 and 19 years old 10 years ago. It's just 7 lines of code. It's an API to make checkout simple online. And the technology, the code that they created is so fantastic that it's been adopted by huge numbers of other startups that are notable. And that's made this a company that's valued in the billions. In fact, when you look at the valuations, it's incredible. In 2016, the company was valued at $9 billion when it was just 5 years old, with 7 lines of code for merchant checkout online as an API. In 2018, it's valued at $20 billion. So it's more than doubled its valuation in a year. And last year, it was valued at $35 billion, almost doubling its valuation once again in just a year. And in fact, they just did another funding round in March 2020, valuing the company at $36 billion. So they're still storming ahead as a major global platform because it's simple code as an API that's plug and play, and it's viewed as beautiful code. Now, the criticality here is that this is a young company. This is a company that's not even a decade old. It launched in 2011. So it's young and it's vibrant and it's a small number of people doing great things. And when you compare that with the banking structure dealt with most of my life, it's radical, because the industrial companies, the banks, were built for the distribution of paper. These guys are built for the distribution of data. The industrial companies are built around a model of buildings and humans. These guys are built around a model of the internet with software and servers. And that's the reason why Stripe is already worth more than 7 Commerzbanks, one of the oldest and biggest banks in Germany. You know, Commerzbank was valued at $6.5 billion in September 2019. Yet it's got 48,000 people compared to the 2,000 in Stripe, and is worth less than a seventh of Stripe. You know, Deutsche Bank is worth just a third of Stripe, and has 91,000 people. And this is the incredible thing, that banks are trying to transform to be digital, but they have far more people and far more infrastructure and far more history to deal with than these young companies have. And this is why the fintech structure is becoming interesting, because the financial structure is very old and the technology structure is very new. One of the key things around this is that we're seeing the banks starting to transform themselves. So the banks, sorry, made a slight mistake of my pressing of buttons there. Let's try and go back. I'm not sure if this is working. Ah, there we go. So the banks are transforming as well. A good example is Barclays Bank, and Jez Staley is the chief executive of Barclays Bank, a bank that used to be a very prestigious investment bank in Europe, but now is moving towards being more of a commercial banking operation on a global basis. But in 2016, valued at $30 billion, so it was worth 50% more than Stripe, but had 13 times the number of people, well, in fact, 130 times the number of people, 130,000 compared to 1,000. But in October 2018, the number of people had reduced dramatically. And this is what we're seeing across the board, that banks are trying to move towards a different model of financial structure that moves away from buildings and humans and physicality and gets more and more into a distribution of data and digitality. You can see here, it's like a platform revolution that we've seen in all markets, but we're now seeing it specifically in the financial markets, where new companies with small, lean numbers of people that are agile are creating far better, substantial models of value than the traditional companies that have large numbers of people. So this platform revolution is transforming financial services, and the banks are not sitting back and letting that just happen and saying, you know, let it go. They're also responding. You know, they've woken up, they're shaking up, and they're investing billions in technology. You know, JP Morgan Chase invested $10.8 billion in 2018 in technology. In 2019, this figure went up to $11.4 billion. To put that in context, the total investment in European fintech was $22 billion in 2018. So 2 years of JP Morgan's IT budget is the total amount invested in European fintech. That kind of puts a context around and a framework around this, that banks are not being destroyed by technology. They are being disturbed by technology. And I think that's the key point, that so many people think banks will be destroyed by technology, disintermediated. and they won't be. What we're doing is we're transforming the banking system to a new system for the new century. And that's something that JP Morgan understands. I mean, they have more developers and engineers than Twitter and Facebook combined. 1 in 5 people who work for JP Morgan Chase are engineers or developers. That's 50,000 people. Yeah, so a lot of people involved in technology. And it's because JP Morgan Chase understand that they don't want to be disrupted, but they want to be the disruptor. They want to be the change agent. And they're doing amazing things with technology that are changing the game, like using artificial intelligence to automate what historically took 360,000 hours of human legal time, or like automating best execution, which is an incredibly complex process, or like creating their own cryptocurrency for settling payments and transactions within their own global platform. And we're seeing not just JP Morgan Chase, but many banks starting to change the way in which they act and think, and trying to work and partner with these new technology startup companies in the fintech community. I often talk about fintech being the marriage of a grown-up and a child, the partnership between a parent and a child. And it's very difficult. The child is technology. The child is very naive, doesn't understand why the world works the way it works, wants to change the world, wants to kick the walls, break things down. And the parent just wants to keep everything nice and stable and secure and reliable and resilient. This is what finance and technology is like. Finance wants stability and resilience, security and reliability. But technology wants to disrupt, to change, to do something new in a different way. It's a very difficult partnership. And in fact, a lot of banks don't understand this partnership, and a lot of technology startups try and have these partnerships with these banks, and they find it very difficult. It doesn't work very well. The bottom line is that banking is what banks do, but technology is now how they do it. And that's a transformational process that every bank is going through in different ways, and finding it very difficult. Initially, we thought that technology would destroy the banks because banks are like dinosaurs. They're very much entrenched in the Industrial Revolution, which is very true. They are based around physical distribution structures. But rather than being destroyed, the banks thought that technology was interesting. And in the second generation of fintech, they started to say, let's invest in these companies, let's support these companies, let's play with these companies. And to be honest, that's what it was. They were just playing. They were doing corporate innovation theatre. Lots of hackathon days and lots of days for fintech startups to play with big banks, but very little connection into the core bank. What we're seeing recently is more collaboration, where the fintech community is seeing banks that truly want to partner with them, but are finding it culturally very challenging to partner with startup companies for the reasons I've given around the parent-child relationship. But eventually, fintech will be integrated into the core of banking. Technology will be integrated into the core of banking. Banks will have renovated and refreshed, rebooted and renewed. They will be different, and they will be based around the internet. And that's going to be something that we'll see emerging over the next decade, speeded up and transformed and turbocharged by the coronavirus pandemic, because we've had to move very quickly towards a technology structure on the internet in finance. One of the things I could talk a lot about, but I don't have time, is how coronavirus is challenging traditional banks, because a lot of them were caught in the cold over this crisis. I know quite a lot of banks that had a backup for their head office, but their backup was based on a terrorist attack, so they had a second office. They didn't have a backup for everyone working from home. So they've all had to move to cloud in the last 3 months, or try to move to cloud. And that's been a big wake-up call and a big challenge. But we're seeing this movement radically transforming banking, and it is being integrated into banking. So when I was working on my latest book, which has just been released, called Doing Digital, I actually sat down and I thought, a lot of people are criticizing banks as being useless and stupid and don't get technology and they'll be disrupted and disintermediated and destroyed. And I didn't see that at all. I felt that banks are not useless and stupid and disrupted, but they are fundamentally challenged by digital transformation. Because how do you change a 200 to 300-year-old institution to be a 21st century company on the internet? So I wrote down the banks that I thought were doing digital well, and I ended up with 5 names of the biggest banks in the world that I thought were trying to do digital well: JP Morgan Chase, BBVA, ING, DBS, and China Merchants Bank. And I reached out to them and asked, can I talk to you about what you're doing and see what lessons we can learn from what you're doing? And luckily they all said yes, and I ended up with over 30 lessons from over 40 interviews with these 5 big banks. And the lessons fall into 4 big buckets, which is working out what to do, how to do it, doing it, and then doing it better forever. Now, these 4 big buckets are actually what seems very simple, but takes a lot of time to go through this process. In fact, the hardest part of this process is the first 2 phases, working out what to do and how to do it. And I think this is typified by the comment from Charles Darwin about the origin of species and survival, which is, it's not that whether you're the fittest, the strongest, the fastest, or the most intelligent that survives. It's the most adaptable to change, but changing in the right way should be added to that statement, because if you change in the wrong way, you're going to fail. And I see so many banks changing in the wrong way because they're changing to be digital as a project and thinking of digital as a channel and delegating it to a project and a function, when actually it's more of a fundamental restructuring of the organizational mindset and recreating the business around the internet. That, to me, is the fundamental survival question. Are you restructuring the traditional financial firm around a digital platform in the internet age? Working out what to do, nearly every one of the 5 banks I spoke to, in fact all of them, said they started by writing down who they thought did digital well, and companies that they noted are the ones we would all think of, like the Amazons and the Alibabas of this world. And they went and visited with them and they said, how do you structure, how do you do things? And a lot of the lessons they learned are now being internalized. For example, the 2-pizza team idea from Amazon. And you may be familiar with this, but the idea is that the company should be structured around very small teams that are agile. And if the team needs more than 2 pizzas for lunch, the team is too big. The ideal team size is about 10 people. I was amazed to see in a couple of these banks that developers and designers were integrated with the product and risk and compliance people, and they were all working together in very small teams. And one of the banks said to me, every time that they have to make a decision around the future, they ask, well, what would Jeff do? And I didn't connect it to Jeff Bezos, but that's what they were saying. What would Jeff Bezos do if he was making this decision within the bank? Those are guiding principles for these organizations. They think like big tech companies. And it took them about 1 or 2 years to work out what to do. Then they had to work out how to internalize that in their own organization. How do you bring the external lessons to be internal? One of the big surprises came from one of the banks that I interviewed, who said they actually spend a major moment where the board of the bank gave the backing to the chairman and chief executive to say, focus on business as unusual. Don't focus on business as usual. We all look after shareholder return and the financial metrics. You focus upon business transformation and change. And I think that's the fundamental point, that it's very difficult to do business as unusual if you have to deliver business as usual. How can you focus on business as unusual? How can you focus on change, transformation, if you have to deliver everything that everyone always expects? It's not going to work. And even if you have that mandate, how do you change the organization? To change the organization, you have to have a burning platform, something that ignites and disturbs the people within the business to change. And then if you ignite and disturb the people, you then have to give them a way in which they have to move. Where are we going? So all of these banks had a moment where they had a burning platform, a critical issue, which they shared with all the people, saying, if we don't transform, we're going to die. And this is where we have to transform to. This is where we're going. Join us on that journey. So one of the key things around how to transform is making it customer-centric. And that's another key thing that was consistent across all these companies. They all talk about customer journeys, customer experience, and being customer obsessed, something that they also learned from Amazon, I guess. And that took another year or two. And then actually doing this transformation is hard. You have to change the organization and the culture and the people and the mindset. And changing people is difficult, particularly if people don't want to change. So that's a big question. How do you change the people? One of the big issues in every company is the frozen middle of the organization that tries to stop change happening. How do you get the middle of the organization to change, particularly when middle management have grown up and gained their role and their capability over years or decades, and they're worried that they're going to lose that power or that skill that they've gained. Equally, are they skilled for the new organization? How do you reskill people? Quite a few of these banks would provide everybody in the organization the opportunity to reskill. So, for example, branch managers could go into an innovation center and learn how to code in Python for an hour every day to get new skills, to transition to new roles. And equally, when you end up with this new organization, how does it work? ING said to me that there used to be 30,000 people working for the bank, and now there are 3,000 teams working for the bank. So the role of management is to orchestrate 3,000 teams or synchronize 3,000 teams. And that, I think, is another critical point. It's around synchronizing the organization, not managing the organization in the way that it used to be done. And that's critically around fast communication and fast decision making. What amazed me is quite a few of these banks allow these 3,000 teams to get access to decision makers within hours. Some of these banks were saying that if a decision needed to be made by the chief executive, they could get that decision made that day. They didn't have to wait for months to get a meeting in their diary. They could get a decision that day from the chief executive. So digital transformation of a financial institution is difficult, but it can be done. And one of the things that I discussed regularly in my circle is, why don't we just launch a new bank and, let's not go through this process? And my answer is always, you have to transform the old bank. Otherwise, what are you going to do? Just let it rot? Let the customers rot with the old bank? Let the employees rot with the old bank? Why would you not transform the old bank? Yeah, it's difficult, but you have to do it. And once it's done, which takes about 5 years, maybe longer, then you have to keep doing this better forever. You have to keep dealing with change, keep dealing with technology. And the underlying aspect of this is data, and data is the air that we breathe. Data is not a fossil fuel, it's not oil. It's the air of the financial institution. It's what enables it to be healthy. And the better the data is organized and managed, the easier it is to breathe. And this is where we want to end in terms of transformation, to be a digital organization leveraging data that gives us customer intimacy for a unique customer experience that bridges across thousands of partnerships. I could talk about so much more, but this is summarizing pretty much some of the things that I've been going through in my experiences. But I'll end with just a final thought on the coronavirus pandemic, which, as I say, has transformed and turbocharged digital for most traditional financial institutions to be the priority right now. And I think that the end game here is that we're seeing everything going away in terms of physicality. Customers have realized when they have to be locked in at home for months that they can do everything online. Thank goodness. But is the organization geared and ready to do everything online for the customer? And that's what I think we've woken up to in the last 3 months. Thanks for listening. I hope it made sense, and I'm ready to take any questions.
Thank you very much, Chris. This was a very interesting presentation that I'm sure not only me but everybody else has also enjoyed, because I have a couple of questions to actually ask you from our viewers at home or in the offices. This one's an interesting one. Are there any technologies that were only part of sci-fi books and movies before but now became a reality in 2020?
Well, I mean, the main reality in 2020 is the move to cloud, which is not something we hear much about in movies and science fiction, unless you want to talk about Skynet in the Terminator, Cyberdyne Systems. Most of us before the pandemic were talking a lot about artificial intelligence. But if I'm honest, artificial intelligence is still pretty dumb. Most of the artificial intelligence that's discussed is things like chatbots, and a chatbot, to be honest, is not that intelligent. It's very basic. What we should see is artificial intelligence becoming much more intelligent over the next few years. And if anything, you'll see that being led by China. I talk a lot about how China is leading the world these days, including creating diseases. But China actually has been leading the world with technology for quite some time. And some people debate this point. I saw something recently online saying, Alipay and WeChat Pay aren't that great. But if you look at Alipay in particular, and I have a slide I sometimes use, they have a structure based around the super app, which is the social, commercial, financial interactions and interchange as the front-end experience for the customer. But behind that, they have the Alibaba Cloud, Alipay and Financial, which is the payment system, financial system. But specifically, they have a artificial intelligence system around data management called Ali Mama, because Mama looks after Baba. And that data management system is the criticality. So when I say data is the air, I think that's the core technology that we have to focus upon around how do we use data and leverage data to create better customer experience.
So effectively, we're saying that we are looking into China becoming a leader. Well, obviously, we can already probably see China as a leader in the technology industry either way. But you're saying AI. Do you think that that poses any kind of risks to the entire world?
There's always risk. There's always fear of the future. There's always fear of change. And that's a basic human thing, which is we always worry about the march of technology and innovation and progress and what it means for human rights, for example. At the end of the day, you have a balance. When you look at politics and government, some countries have far left, some countries have far right, most countries have something in the middle. And that's because we as humans create a balance that stops the extremes. And we'll do the same with technology, that we'll worry about the extremes of technology progress and what it means for human rights and human activities, but we'll manage that balance through the whole way in which we structure our organizations and our work.
Hopefully, it doesn't require us to fall into any kind of pitfalls before we actually find that balance. But I have another question from the audience, from online in the chat platform. So the question sounds like this. Some say that there is a banking crisis looming not far in the horizon. In this case, how do you see it unraveling, and do European banks fall first?
I mean, I don't have the answer to this one. I'm quite happy to say that I can predict the future with technology, but when it comes to economics and politics, I have no idea. Um, so right now, the banking system is being propped up by a lot of government support, as is the whole of the financial and economic system. And the question, I guess, is more geared towards how long will that governmental support last? One of the articles I saw today, in fact, was talking about the exposure that banks have in what will be non-performing loans. And that is a big concern. Having said that, I'm fairly sure that whatever happens, governments will sort it out as they did 12 years ago. So yes, we may have another financial crisis right now, and we may see a lot of banks moving towards the brink of extinction. But I'm pretty sure what will happen is we'll just get more bouts of quantitative easing and governmental activity that plugs the hole, or hopefully plugs the hole.
Yeah, well, you have to have a crystal ball to be able to predict with accuracy, right? And we don't have that here right now. So let's move on to another question. And obviously, there has to be at least one question about Brexit, right? So, and the question sounds like this. London was a financial center for a long time. Do you think that it will potentially, or is at risk of losing its title now that Brexit has happened? And will London find potentially other ways to lure in financial firms?
I mean, London and the UK has a lot of things in its favour, which has nothing to do with being part of Europe. It's to do with openness, light regulation, governmental support of innovation and technological capability, and the skill sets of adjacency between the financial community, the technology community, the regulatory community, the community of change. And yes, a lot of other cities have this. You know, Vilnius is a fantastic centre for fintech innovation as well, for similar reasons. But the critical mass of talent and people is what makes a difference with London, in that although Vilnius has a great capability for fintech, it's quite a small place, and London is not. So you have to take that into account. And when I take that into account, it's the reason why I don't see the same adjacencies of talent and capability in Paris, Amsterdam, Frankfurt, or other places. And it's really to do with the size of the metropolis. It's the size of that centre that makes it unique. And someone said some time ago that countries are no longer countries; cities are countries. So London is a country. If you think of it that way, it's nothing to do with being part of Europe. It's to do with being a global centre of talent and adjacency and capability.
So effectively, we're moving back to ancient Greek times with polises, right, rather than an actual country. That's what's becoming important. A quick question on an unrelated note, and probably will be our last question for you, Chris. Do you see any of the tech giants, as Amazon, for instance, to move into the financial sector?
It's a question that comes up regularly, and that I blog about regularly, and that whenever I blog about it, I say Amazon, Alibaba, Facebook, Apple, they all make more money out of banks than they ever would by competing with banks. So why would they compete with banks? When banking has far more regulation and far more oversight from government than technology, it's a pain to even get into this space. And to actually try and compete in that space is going to bite the hand that feeds those companies. So they'll never move into full-scale banking. They'll move into a lot of areas of banking services that are not core, like credit and payments, loans and savings. But full deposit services and full commercial banking services, no way, never.
Thanks very much. Chris Skinner, one more time, ladies and gentlemen, you can send your virtual applause, love, and hugs to Chris. Thank you very much for actually spending your time with us today and honoring us. So thank you. It was a pleasure, Chris. And you will be able, I saw a question pop up really quickly on the screen. Will the recording be available? Yes, it will. Look out for it tomorrow. And Chris, one more time, thank you for your time. Enjoy the rest of your day.
Thank you for having me.